And we're live.
What time is it in the world?
It says live to me.
Yeah.
Yep.
Let's go.
Now we're live. What's up, amigos? 10:30 a.m. on the West Coast, West Coast, 1:30 p.m. on the East Coast, Least Coast, 5:30 a.m. or p.m. somewhere else in the world. I don't know. 5:30 p.m. UTC. It's going to be like 3 a.m. on the East Coast of Australia. What's happening, fellas?
What's good, my man?
This feels like a very quiet market to me. I got to be honest. I don't know what this doesn't seem to be much going on.
Yeah, new permanent high plateau. It's quiet.
Yeah.
It's all good.
Had a quick look on multiple.com today for the Schiller PE at 37.1.
Ooh,
Nothing matters anymore.
that's fair.
Just got to grow.
I mean, really, can you tell me anywhere or any asset that is truly priced at like a peak pessimism right now?
Cash.
Fair. Billy, anything peak pessimism on planet Earth? Do you have to go intergalactic? What's the...
I don't know. Probably value stocks.
We got a
Value's still
volcano
cheap.
in St. Vincent. Maybe something's in the Caribbean. I don't know.
Bullish.
I mean, I
Bullish.
bet, I don't know. I bet there's something in emerging markets that's not doing great.
You think about all of the industry that when that volcano wipes out a whole town, they're going to have to rebuild that town. You think
We're
about
going to
all
be
that.
so wealthy rebuilding that town.
That's going to be straight to GDP.
Straight to GDP.
This is Value After Hours. I'm Tobias Carlisle. I'm joined by Jake Taylor and Bill Brewster, as always. What are we talking about today, fellas? I don't have a great deal on. I'm sort of confused about this market. So I'm always eager to hear people who know what they're talking about. What's happening?
I'm going to heavily tell people to do their own due diligence and then pitch a microcap complex, which
There we
I'm
go.
thrilled about doing, but y'all have been with me long enough that you can hear how my mind worked on this one.
All right. And I've prepared a little veggie segment on cheetahs today, since apparently it kind of cracks me up, our fans, in that they love the animal analogies for some reason. And it's like, why do you come to an investing podcast to hear about animals? This is like, you could go on Animal Planet or anything else to get actual real facts about animals.
Yeah,
but
I think to be fair, it's one animal. There we go.
the sperm whale, yeah.
No,
It's only
people
the
like
sperm whale.
ants too, man.
Well, it kind of reminds me of like the silliness of the way that we judge Miss America on her answer to like difficult political questions. It's like, why is that? Why
It's
do we
important. It's important. What does she look like in a swimsuit, and what does she think about
And-
Libya?
You know,
Yeah. And others such as the Iraq.
There we go.
you know who I found out was a Miss America? Well, I guess she was Miss New York or something. But Julia LaRoche. I never knew that Sally Pancakes was part of that contest.
Thanks
you
for
have it.
listening.
What?
Shout out
I
to
don't know
her.
that she listens to us. She's got her own thing going on, but she probably does stop whatever she's doing to listen. That's a
Yeah,
good
come on,
point.
Bill. Let's be real here.
I had a closed chat with Aswath Damodaran last week, and I was Aswath said that he's watched a few episodes. So, how are you, Professor? If you're listening,
Shout out to him.
Probably taking notes on all the wrong things we say.
yeah, I think that's what happened. I think we might have name checked him in one. Hopefully it was
I
polite.
shouldn't say that Julia LaRoche doesn't listen because she's sort of friendly or has been seen around Munger things. And we all know that Charlie is
Charlie's a
definitely
big fan.
clearing his schedule, throwing on the television to see us right now.
Yeah,
Yeah, he's got somebody
not?
to put it up for him. Makes sense.
Yeah. All right.
wants
So
to
you
take it
cool if I
away?
start this thing?
yeah. Let's do it.
All right. So let's talk about how I got introduced to Kyle Sermonara. My man Mike Mitchell is like going through his life trying to find liquidations for, a 10% return is sort of how he has described it to me. And if I'm misquoting the return he's looking for, I apologize. So he stumbles upon an entity that he thinks might be a liquidation candidate, and gets on the phone and calls Kyle to see how Kyle thinks about the world. Okay, this is like good old fashioned, just working hard, picking up the phone, calling people. All of a sudden, he's like, this guy thinks like I do, right? And starts to like pay attention to some of his entities. And I know what Mike does. I'm sure he did very deep work on Kyle, and they got to know each other. So for the longest time, Mike and I are talking about Curate, and he's like, you should check out this guy Kyle, you should check out these other entities, you should check out this, and I'm like, I don't know that I want to hear this stuff, like whatever. And then eventually I said, all right, I'll start to look, and I see that they buy like a lumber mill, and I was like, oh, that sounds like the worst possible idea that I could ever hear. And
what's the time frame for that?
A lot of this stuff happened over the past 12 months, when they first bought Green First in that Kenora mill. And I have followed Fairfax long enough to be interested in Resolute, and long enough to know that I don't know anything about commodity companies. And my history in banking terrifies me of commodity companies. So I was like, I am not into this at all. And meanwhile, Mike's like chirping in my ear and chirping in my ear. And then my podcast drops, and like Kyle listened because it was Mike's. And then I get like this random guy is sending me comments on how I didn't spell words correctly in my show notes. And I was like, who the hell are you, man? So then he's like, also, I don't think that the show.
It's Buffett with 2 T's.
No, come on now. I didn't do that. But like he was like picking apart like super detail, like oriented stuff in the show notes. I was like, dude, I'm just trying to make a podcast. So anyway, like we started to talk, and I started to watch what they've been doing. In Ballantyne, I think that they've made a lot of acquisitions or divestitures, right? They sold the one business, Convergent, I think. I like that they flipped the business, the sign business, into Firefly. And then I started to like research OpFi, which I'm gonna interview the CEO here tomorrow. But like I probably would not be open at all to that entity if it wasn't for my podcast with Tyrone V. Ross, who is just like an incredible dude, and really, to me, opened up my mind to like the underbanked and the need for credit. And for me, looking at OpFi from the outside, it looks I can frame it as like a predatory lender, and I hope to have like a good conversation with Jared, the CEO, tomorrow. And I'm gonna try not to do like a puff piece. I'm a little bit intimidated about asking
coming hard in the paint.
Yeah, well, yeah, and like I don't want to like come at him, but I do have like real questions, right?
Just frame it up like people say.
Yeah, man,
I have heard. What do you say too?
I mean, dude, it's the APRs are really big, right? But like, they're almost 36% on some of the products. What I would say is like I've gotten to know Kyle pretty well over the past, I don't know, 7-8 months, whatever. And since the podcast dropped, you can do the time. I really believe that guy is doing things for the right reasons. And like, I really believe that he wants to make his minority shareholders, get good outcomes for them. And he's got friends and family in a lot of these entities. And that's kind of why I highlighted him. As far as, FG&A or OpFi goes, I mean, I see an entity there that you've got Joe Moglia, who built TD Ameritrade into what it is and sold it to Schwab, and Kyle, who are financial analysts. Like Kyle's background is in financials. They both are like really passionate when they speak. You can hear Joe on Josh Brown's The Compound Show, about like rebuilding credit for people that the banking system has left behind. and I think that, that's a mission that's easy to like look down at for as somebody that's, able to go to a bank. But like I said, Tyrone really kind of shifted the way that I think about that subprime credit group. So I look at that entity and I say, okay, well, here's Joe and Kyle, and they're like seriously motivated to make this thing work. And the reason, I think, when you really cut through everything, is like they have the ability to potentially become a SPAC machine. And if they can do SPAC after SPAC after SPAC, the economics are really, really interesting in these. And they just filed for another SPAC. So if they can do good deals and they can keep it coming, to me, that's a really, really interesting setup. And they have a public entity. And I'm telling you, if you just listen to me and you go out and buy it and you get slaughtered, it is not on me. It's 100% on you, because it's a $28 million market cap and I don't want to hear shit for it if it goes wrong. But it's FG Financial Group. And I think if you look into that entity, you can kind of see how there could be some potentially interesting outcomes.
That's the SPAC machine.
I don't know that it's the SPAC machine necessarily,
it's not.
But
it's
yeah,
not a
I mean,
SPAC. It's a SPAC it's pumping out the SPACs.
Yeah, when you read the 10K, I mean, they have a SPAC platform, and they're writing D&O insurance, directors and officers insurance, on some of the management teams that are trying to do SPACs. So when you
this almost sounds like, is this accurate to say that like there's sort of it's the overlapping of a bunch of podcasts that you've done that sort of all like this little spot that sort of meets there. You had the one on SPACs. I forget who that was with. You had
Andy
microcap.
Walker,
yeah. You had microcap with Ian. You had, DeFi with Tyrone, and then Kyle himself. So put those all together into one, and like you sort of get that thesis emerges out of that.
Jake Taylor, you have decoded the brain of Bill Brewster. So when
I'll tell your wife.
No, so dude, when people say, how do you do all this media and come up with investment ideas? I mean, look at what Ballantyne has done over the past week. A lot of that is because I put in a fair amount of hard work and open my mind and try to have conversations with people that don't think like me all day long. And, to me, this is sort of my idea that I've come up with since Curate, is to bet on Kyle's complex. It's hard because there's a lot of intercompany holdings. I did not participate in any meaningful way in the Green First thing except through Ballantyne. But like I said, I mean, I couldn't. Part of why I'm saying do your own work is like I got Mike chirping in my ear every day about how much he's making at Green First, and like I just knew that I couldn't hold that entity at the prices that it was, trading at. So you got to make your own decisions. But turns out Mike might make a ton of money here shortly. So anyway, I guess that long story short, I see a microcap team that I think is high integrity, has the right incentive structure, and I've gotten to be friendly with these guys. I'm not like friends or anything, but I'm willing to put some of my reputation on it. I will tell you that when you talk about them, people are going to probably say negative things about this guy, Larry Sweats, who's involved. Larry is Kyle's CEO right now. To me, I'm not saying that other people don't have reasons not to like him, but if you look at what they've done over the past 12 months with a cash pile turned into the deal that they announced yesterday, Larry's got a lot to do with that. Like I shouldn't say most because I don't know what's going on behind the scenes, but I know that he's putting ideas together, and he forewent his rights in that particular deal in order to give the other shareholders the ability to keep their rights and to get the deal done. Now, a cynic's going to say, well, it's a forced capital raise. They need more capital to do the deal. So somebody's got to do it. And at least the current shareholders get the first shot. So, it's not perfect. Nothing in life is. I think you got to sort of figure out how you read the tea leaves. But this is what I do all day. And it kind of came together. This is my first idea since September. So
I like
that's
rights
it.
offerings in general better than a secondary.
They're
Gives
fairer.
a yeah, it's like a kind of right of refusal for the original shareholders.
Are the rights renounceable? Are they? Can you sell them into the market, or are they? You got to take them up yourself.
They're, I mean, they haven't gotten the approvals to know the
Okay,
answers
not at
to
that
that
point yet.
question.
Okay.
I do think that if you listen to the call yesterday, Ballantyne has a lot of the rights to, like, Ballantyne owns a fair amount of Green First, so Ballantyne's getting a fair amount of rights. Kyle had said that he would like the rights to trade because I think that they said that they're not going to fully participate, but I'm not certain on that. You know, you got to confirm that for yourself. But I do think, like, really, there's a lot of alignment of incentives here. There's a lot of cross holdings. There's a lot of, legal entities. When you read FG Financial, like, it's a lot of different entities owning each other. I don't know. Is that much different than what KKR looks like on the inside? I'd argue probably not.
Blue chip stamps in 1978.
Yeah, well, that's so part of it. I mean, part of what kept me away in the very beginning was I said to Kyle, I was like, dude, this is freaking complicated. And he was like, well,
Yeah.
tell me what Buffett's entities used to look like when he was starting out. And I was like, that's a pretty good point.
There is always kind of a question mark, though, on small and complicated, right?
Yeah.
Like, does it have to be that complicated when you're that small?
Fucking listen to me and go out and buy this stuff. Do not do it. But if you want to know how my brain works, like as a fan, that's what's going on. But yes, I totally agree with you, Jake. I think that there should be a massive rebuttable presumption when you see complicated and small.
Yeah. How much of your net worth are you willing to tip towards something small and complicated like that?
So I think as of today, I think like 7% is in Ballantyne. I think like 2% is in FG Financial, because the problem with FG Financial, in my opinion, is if something did happen with OpFi, like I think a lot of the future value is in the SPACs and the ability to do deals. And I wouldn't like bail on Kyle or anything if something were to happen somehow. I mean, they've reached a definitive agreement to do a deal, but let's say something happens. Then you've got like a little bit of a broken story and you've got an illiquid market. So I think you really got to be willing to tie up the capital for a while. And then in OpFi, I think I have like, I don't know, 1.75 or 2% or something like that. So across the whole complex, it's like 11%.
Yeah, that's a decent amount for that size of probably the smallest you've ever been, huh? If on the in general.
Yeah. Like market cap wise, other than some LP investments, for sure. I have like one venture bet that's
some
like
baseball cards and
yeah. I bought some baseball cards in 2016, and now they're like my entire net worth. But other than that, so I don't know. I mean, I really don't recommend that people just like go out, and I personally, like a younger me, or if my family was asking, I'd probably stick to Ballantyne and FGNA, just because I think that there's a ton of incentives to make FGNA work. And I don't know. I got some questions for the CEO, but I really do think that when you look at Joe Mowgli and Kyle in a financial entity, that's like a compelling combination for me.
Do you hold any JT?
I don't discuss that kind of thing.
Well, I'm just thinking we might need to disclose it, given we've talked about it so much, just in some proportion, just if you hold them or not.
I will say then yes, but it's small.
Yeah, I don't hold any, just so we're clear.
Did I make you nervous, Toby? I'm sorry.
No, I just want to make sure that you're disclosing, but I'm not. I'm just careful about that stuff. I have to be careful about that.
No, I dig, man, and I'm not. I don't know. I have a worry, especially when you're talking about like this small, that like I'm not trying to pump some stocks. I mean, I said in the podcast that I would, hold this stuff for a year. That thing was recorded 3 weeks ago. I'm not this is not like an in and out thing. Like I am allocating capital to Kyle to run for a while. But you know, I don't think that people should listen to this and go out and buy those. I don't think they should ever do it. But particularly here, you're not going to have liquidity when you want it.
DYODD.
Yeah, like bigly though, not like kind of. You know?
Yeah.
Listen to the other podcast as well.
No, well, like but
yeah, that's the DD.
But you know, like what did I called everybody that contacted me, whether they had something negative or positive to say, and I asked them, like, can you walk me through what you see here that's negative? And positive. And like one of the anecdotes that came back about Joe Moglia was he sold TD Ameritrade, and I guess he wanted to coach again. And like this guy, I think it was University of Nebraska or something, but he went and he worked for free. And then at the end of it, like donated to the program. And when he was there, like worked his ass off, you know, and like he's coaching young kids at Coastal Carolina. When he talks about those kids, he really seems to care about making a difference in people's lives. And that's kind of why I have my mind open to this idea of what is otherwise, you know, perceived as a subprime lender, because I feel for the people that, you know, have been left behind by the banking system and that are basically relegated to payday lending and can't get a loan to fix their car. Now, that said, you know, like one of the questions that I'd like to ask this guy, Jared, tomorrow is the credit card that they just announced has a $99 fee for a $1,000 credit limit. I mean, that is a big percentage of your credit limit in an upfront fee, right? It's a yearly fee, but that's like 9% of your credit limit. And then your APR is like 36. So what is the way that people are going to have their credit repaired, and how over time, like, is there a way to drive down the fees that we're charging these people? Like, I don't want to gouge people. That's not what I want to be associated with, but I don't think that Joe and Kyle do either, to be honest. I just think
God, a $99 fee for the $1,000 limit, and then I don't know what's the Costco membership, like $99, or maybe it's a little higher now. I think.
Well, dude, this is what Tyrone said, right? It's expensive to be poor in this country. I mean, that was what Tyrone's like whole episode was on, is like how fucking hard it is when you're poor in this country, and like it shouldn't be that way.
Yeah, that's messed up.
On the other hand, you got to price risk right. I mean, like the defaults on some of those loans, there's a lot of charge-offs that they have. So, you know, I'd like to know how they think about that. What are they going to do in the future?
When I first got to the States, they gave me, I had to get a credit card because I had no credit history. I got a $500 credit limit, and I had to back it with $500 in a separate account.
Wow.
I don't know what I paid for the card, but it was a Visa, so I assume there was some. It could have been $100 attached to that card.
So you had to be collateralized 1-to-1?
Yeah.
Yeah.
And then over time, they extended the credit limit, and they didn't require me to put up any more cash. But
those dodgy Australians kind of makes sense.
Dude, my credit history is still like, because I've been in the States, on and off since 2004, but for the last 10 years, like all of my accounts are still like, that's still the orange, like on my credit report, it's still, because my accounts are young, because they're just a blend of accounts that are like, I think the average age is between 5 and 8 years, something like that.
Yeah, it's it's weird. Like, I mean, it's not weird. It's just something that I've never had to deal with, and like, I've talked about it before, but my mom has gotten by on like just straight hustle. Like she's she can outwork anybody, but she like doesn't have a money mind, and she's the person that's calling like when there's some email that's, fucking Stansbury Research is writing her. She's like calling me with their next pick, like the next gold play or whatever, the thing that's going to go up 10,000%. Stop sending those things, guys. Anyway.
What about the Motley Fool? They're just as bad, aren't they? We've held Amazon since it was $2.
Yeah, you're asking me to go up my man.
Yeah.
But yeah, I mean, yes, their marketing arm, I think, could use a little bit more
discretion.
Yeah. And dude, I'll tell you what's hard is it's hard to have a discussion about like this idea, the Kyle's complex, without feeling a little bit like that. Because what I mean, they are so small, and like I mean, they're way bigger than anything I own, right? But like, objectively, they're micro caps. So I worry about people getting into stuff that there's a lot of risk there, right? You got to really believe in the people that you're betting on and be willing to lock up your capital and stuff. Jake, how do you get out of these positions, man? I got one that's a liquid. It's just like sitting there. I don't think the bid and ask has changed in, I don't know, 2 months. It's like, what are you doing? It's amazing that people might mark their book to that.
Yeah, no doubt. That is well, I'm not going to
like do some
throw
people
stones,
just get their...
but there's some marks on some funds where I got to kind of scratch my head once in a while about like, really? You're just going to mark it to that kind of, and you're the only one who's really even in there doing anything in that market.
Yeah, right. It's like they call up their mom. Hey, mom, go hit this for 10 shares or whatever, move the market. And they're like, oh, well, now we can collect fees.
Yeah, let's book those fees on like $200 worth of volume.
Yeah, you should almost do like a volume weighted average mark and exclude what you're buying.
There's no volume though, right? The VWAP for those things is like minuscule.
But you know what I mean? Like, because if you're just looking at the mark, it's just garbage.
There's no good answer. That's why. Yeah. That's kind of why I like, before all of the option silliness, I like leaps and things like that, because if you're wrong and they trade all the way down to like nothing, at least they expire eventually. You can't sell them. Like there's no market there at all, but at least they expire.
Yeah.
Yeah. I've wondered before if there's some efficiency that you could exploit, or inefficiency, I mean, where you would expect window dressing at the end of a quarter, right? And so if you could almost sort of front run that window dressing a little bit somehow, there's money to be made.
Yeah.
The problem is, man, you got to sell it to somebody to get out of your front run.
Well, you sell it to the guy who wants to pump the stock up before the end of the quarter for his marks. Yeah,
that's fair.
The quarter end moves are a joke, right? I don't know why they don't police that a little bit more. Like, you got to be, they're so transparent for the most part. Runs up right into the end of the quarter, and then the first day back, it trades back where it was 3 days earlier. You guys see that the kid who had the $80 Nvidia put, and he had he had $20,000 to his name. He had $20,000 in this position, so I need to have a chat about risk management with him. But he needed, I think it was Nvidia. I'm pretty sure it was Nvidia, but it had to close below $80 by Friday, or he was wiped out. And so it ran to like 81 or 2 or 3. And he was wiped out because it closed above that on Friday. And then on Monday, it opened below $80.
Ah, brutal.
And he was in a hotel, like he's done a TikTok in a hotel room saying he's going to show how he's going to make it all back. But rough.
I suspect he's going to try to trade options.
Right?
Yeah. He's not making it back trading options.
He's got no stake. He's going to have to get his grub stake back together.
So you're telling me he put everything into an option that was expiring?
In like a week?
I don't know when he put the position on, but there's lots of people doing silly stuff in options. Like I see it on the other side. I saw the Tesla call when Tesla was at 600 on a Tuesday, with options expiring on the Friday, the 650s were going through. I'm like, the 650s were going through in volume. Like, why would you be buying the 650s with 4 days to run when the stock's at 600? Like in size, it just makes no sense at all, unless you have some other intention with those, push the price up a little bit.
St. Petersburg paradox. Those lotto tickets get mispriced.
Yeah, that's fair, I guess. But anyway, they were right. They were in the money. They were well in the money by the time it expired on that particular trade. Yeah.
Until it doesn't.
You want to do your veggies, JT?
Options, just for anybody that doesn't know, like, because, we do have some people that tune in here to learn. Like, just be careful with options. If you must trade them very small. Like, trade a contract. See how it goes. Do it for a while.
I think if it's your first time in options, the things you got to be careful of, there's a massive bid-ask spread. So you're going to lose the money in the spread. The second thing to be careful of is that if you short an option, like that you can lose a large amount of money being short an option, much bigger than the amount of money that you put up. So probably you want to be long options until you really know what you're doing. And even then, you can vaporize a lot of money, but at least you can only lose what you put up.
I think the other thing too is that you have to recognize that they're different markets, and so the underlying can do what you thought it was going to do, and the price of that option will not necessarily do what you thought it was going to do.
Right.
Which is like kind of a mind F when you first, I think, when people first get in there.
You need to understand volatility in some of the Greeks.
Yeah, because you get this thing called vol crush, where like you buy, say you think that a stock's going to 30, or 38 or whatever, and you're like, oh, I'll buy the 30, and the stock's at 20, but you might have to pay $8 to get the 30, so you were right on the price, and then you lost everything. Congrats, right? Or did you break even?
Close enough.
Anyway, you know what I'm saying? Like you got to make sure that you figure out I guess you didn't lose everything because it was worth 8, but anyway, you didn't make what you thought you were going to make.
I do think there are some spots where if you're a value investor, if you're a fundamental investor, you do have an edge over the people who are trading them mathematically. And I think that that's in leaps. You can get that edge because you can have a view on the fundamentals where, and this is, there's a good discussion of it in The Big Short where they talk about there are options that were priced as if they had they have a normal distribution, and these guys had a view that they had there were two outcomes possible. There was either win a lot or lose a lot. And once you have that kind of framework, you can Kelly bet those positions. And if you have enough of them, you should be in a sort of you should have a positive expected return over time. It requires some sophistication to kind of get to the point where you're finding these things that are, binomial kind of bets with a normal distribution price offered. But then I also think that there are, with a leap, with a fundamental where there's no volatility in the stock. The stock's very, very cheap, hasn't done anything for a long time. Underlying's been doing pretty well. You can put on a small position at the money. 2 years later, you can make quite a lot of money on those things, but you got to be prepared to vaporize the lot. You got to think about the amount of money that you're putting on as pure risk capital, not like a stock where some of it, there's still going to be some underlying value over time.
Yeah, I think.
Yeah, you're trading time for asymmetry often.
I'll tell you what's interesting is, when you guys were saying that Intel was really cheap, and I was like, I don't know. Since then, if you had bought the options, you would have done pretty well. But like that might be a scenario that I'd be kind of interested in leaps in that kind of a scenario, right? Because like the concern on that name, I think, is that they've like fallen behind technically, but you may be able to get some of the upside. I haven't done the work to know if the options were mispriced, but I could kind of see myself, because then you could get more upside with putting less at risk. And in a leap, you're not going to it's not going to bleed to zero tomorrow, right? You've got 2 years where you can still sell it with some time in it.
They're very illiquid. You're probably not going to be able to get out of them unless the market moves well into your favor and you move well into the money. But that's why like at the money, or like one strike out of the money with 2 years to run, and the amount of money that you're prepared to lose in that position. And then if it works, you capture all the upside. And if it doesn't work, then you already know how much you're going to lose. And you've got 2 years for the bet.
You weren't going to win anyway.
Yeah, that's right. Yeah.
So you would think about it if you were like, okay, well, this is a position that I'm willing to lose 1% in. Then you would say, all right, I'll put 1% in these leaps. And if it goes to zero, that's kind of what I was willing to risk anyway.
And that's not that's a complete ripoff of Greenblatt's strategy, which he discusses in the Yellow Book, where he says, if you've got something and you think that the downside is potentially a donut or it's got big downside, then, you're already in a sort of option-like payoff. So just focus it a little bit more with the option and think about what you can lose in it and be
You're
honest.
in an option probability set, but you want to get the option payoff structure.
That's it.
Yeah.
You know how I'd screw myself on that? I'd sell the front month option, trying to harvest
to fund
like
it.
A little extra, just like a little extra premium, and then it would rip, and I'd be like, "Fuck."
Hedge myself right into a loss.
That's right. Yeah.
I've never done anything smart hedging options or trading options around like that. That's just, yeah, every time I've dinged myself up, it's because I've been trying to do spreads or calls or something smart in there.
Yeah, I've
Call
always
reapers,
liked
sorry.
the what did you say? Call what?
Call reapers. I've been doing spreads or call reapers, something like that. Like just
What's a call reaper?
You're trading the same, like you're trading different months of the same. So
okay, so like a calendar spread or something like that.
So I might be short the front month and long the second month or whatever.
Yeah.
You know, so,
Yeah, that's what I was saying. That's how I'd screw myself in our leap example, right? I'd be like, oh, just give me some premium, and then it'd rip, and I'd be like, shit. I always like the idea of selling spreads because I do like the idea of harvesting, some of the rent.
The vol.
Yeah, that's right. But
I love the idea too. I've just never managed to do it successfully.
Yeah, neither have I, man. It's been I mean, I tried when I was in law school. I probably spent as much time studying options trading that second year as I did studying law school.
Just lucky there was no Robin Hood back then.
Yeah, well, my tuition in law school increased as my losses in options increased. It's like I just wasn't very good at it. That's why I don't touch them anymore for the most part. I guess I'd sell a covered call on a
there's lots of stuff that's like
stuff like
basically
that.
hedged.
Yeah. If you wanted to trim a position, I could kind of see like emotionally saying that it makes some sense to sell a call because it's easier to deal with. But I don't know.
I also think if you're in something like you just, if it's a Berkshire and it goes down and it gets a lot of vol in it, I would sell a put in that instance. But it's because I'm prepared to accept Berkshire downside, equity downside.
Yeah. So like March 2020, you might be willing to.
There's probably never going to be enough vol in Berkshire, to be fair.
I shouldn't say like at the bottom. Let's say February 2020, once it started to cash.
Well, that probably would have hurt.
Yeah, you get put it. Well, that's the danger of that game, right?
That's okay. If you're happy to take it, then
that's right.
Then that's great. You're just buying it cheaper than you otherwise would. The problem is that the stuff that you really want to own, you never get to own. You only ever own the core. You only ever own the vol. And then the stuff that you don't want to own, that's the stuff you get put.
And you got to have the cash to collateral. Like you have to be willing to come to the table to buy your position, right? So like your cash is sort of suboptimally used.
Yeah.
You guys want to do an option show? We could just do an option show.
Well, I think we just did.
Did we? Did we just do one?
That's everything I know.
I have a feeling it's not. This is actually part of what we connected over at Berkshire. We were talking about all kinds of yeah, man, the first night. Yeah. Anyway.
I don't know. I'll take your word for that.
I remember it vividly until I don't. Until everything went dark at a bar screaming. Those are the days.
Let's do veggies. Let's cleanse the palate with some veggies. We need some sorbet.
All right, let's get it cleaned up. So cheetahs today. It's not sperm whales, sorry, but I'm going to keep this relatively short, but these are just some facts at the beginning because you guys like these facts, even though they don't really mean anything for investing. But
everybody's subscribed to Cheetah Facts.
Yeah. So cheetahs, carnivores, meat only, no veggies, ironically. But so they evolved to live in very dry environments, and they can get by with having like one drink every 3 to 4 days, which is not normal for most animals, obviously. Everyone knows they're the fastest land animal, and they can get up to speeds of like 70 miles an hour. However, what I didn't know was that they can get up to like close to full speed in like 3 seconds. So the acceleration is just off the charts. And one of the ways they do that is they have this heart that is like a turbo pump. Like it can go from like their normal beating is like 120 beats per minute. Which would be fast for a human, right? Like that's like us jogging, but for them, that's their normal run rate. But within like 3 seconds, they can ramp up to like 250 beats per minute. So this thing is a high performance heart, especially relative to our clunkers. What's interesting that I really want to focus on is that cheetahs went through an evolutionary bottleneck maybe a few thousand years ago, to the point where their DNA is remarkably similar to each other. And in fact, you can take a graft from one cheetah to another and it won't reject it. Like they're almost interchangeable parts. because their DNA are so close together. And whereas, if they had had time to evolve and be apart from each other, there's a greater chance of, the immune system, rearing up and seeing other part of flesh as a foreign flesh.
Are they
foreign
geographically
invader.
distributed, or are they only sort of all found in the veldt in Africa somewhere?
Yeah, mostly. I mean, I think there are two sort of, I don't know if you call them subspecies or what, but there's like an Asian one, and then there's obviously the one in Africa that we kind of all think of.
Okay.
So to draw this, cut out some of this and make it a little easier. To draw this back to an investing idea I had while I was reading this, is it possible that sort of like value investors are going through an evolutionary bottleneck right now, and that on the other side of that is sort of the like growthier version, maybe more quality focused value guys who survived through this evolutionary bottleneck? And if that's the case, like, what does that mean then for the other flavors of value? What does it mean? Does that mean that like one value guy could go from a shop, or girl could go from one shop to another very easily, like a graft going from one cheetah to another? And there'd be less chance of a rejection because like they're all sort of all the same because they're the only ones who survived through the last 10 years. I don't know. What do you guys think about that?
I watched I tweeted out something that you said last week today, and I was just reading through what you said, and it was very interesting. You were talking about two different types of value, right? Where there's value who basically based on what the financial statements show, and then assuming that they basically continue on, and then there's some mean reversion to that, that trajectory revealed in the financial statements. And I would say that's what I do. And then there's another version of it where you look at total addressable markets, you try and work out what the revenue, what their share is going to be, what their revenue rate's going to be, what their margins are likely going to be. And then you're basically forecasting what's going to happen. And that's
pro forma together,
right?
Financial statements.
And that's what I would say, like VCs used to do. That was sort of like when I did university, I did finance at university, that was like the VC model that was how they valued. You try and work out how big the market is, what you're going to make out of it, and so on. But it was, everybody sort of knew that it was necessarily very imprecise. And I think that latter one is the one that is in ascendancy at the moment. I don't think there are very many people who are proud to be, traditional value investors who look at the financial statements that way. And
I am,
because the performance hasn't really worked, right? Fair enough.
I'm telling you, like Gabelli's value with a catalyst thing is the framework that I try to look at. I don't like just like a cheap value play, but I do like, like when I got interested in Kyle's companies was when assets started to get sold and 8Ks started to get rolled out. And it's like, okay, you can see the change going on under here if you're paying attention. With Curate, it was when that capital allocation decision was changed. Like I like that stuff. I don't like for some reason I can't get down with buybacks on cheap companies. Like I just don't like the idea of but dude, I don't know, because how do you think through okay, you say that. I think maybe this is the distinction. You tend to look for companies that are still growing, though, right?
Not necessarily.
No?
Not.
Because I don't like the idea of buying back more and more of a shrinking ice cube. I'd rather get my cash out once the ice cube starts to shrink.
Yeah, I just think that most instances, there's a lot more cyclical than there is secular. So when you see something shrinking, it's often...
just like a function of what's going on.
Shrinking for now.
And I think Intel's a good example of something like that. I don't know the answer on Intel. I just think that it's still got very fat margins. It's still got very high returns on invested capital. It's still, Intel is forecast to keep on growing, but I don't know what the outcome is. I don't know if it's going to lose out to the others or not. I just think that you're kind of getting the right price, or you were. I don't know where it is now necessarily, but you were getting this sort of extreme price to have that, to take that position. And I saw all of the, I know all of the bear arguments on it. I'm nervous about it as well. I don't see how it's going to work necessarily, but I just think that you put in enough of those positions and they do as a kind of portfolio they work out.
Yeah, that makes sense.
It's been interesting to see a little resurgence in the deep value stuff with Roaring Kitty and with what Mike Mitchell's doing and a few other guys like that. Like the DNA might not have all gone.
We didn't maybe extinct the whole species yet.
But then maybe by virtue of the fact that there are books, people go back and read old books and say, oh, this trick that people do something, everybody starts doing it. The trick disappears, the alpha from the strategy disappears, and then people don't do it anymore. And then when people stop doing it, then maybe sometimes it comes back.
Yeah, I think Mike would also say that like the liquidation strategy, you can only do at a small scale in the way that he was playing it. So I don't know.
Yeah, it might not be an institutional
too, right? Yeah. So one of the things that's kind of hard, like when you're talking to other people in the industry, is I think there's like this natural filter. And Jake, this goes back to what you've said a lot about the edge of the small investor, and it's what Ian says. And but a lot of people like filter out like, that's too small. I can't do it. I don't want to look at it. It's just not worth my time. And like, you can understand that, but that doesn't mean that you can't make money doing it, right? You're just playing a fundamentally different game. So it's kind of hard to then talk about the game that you're playing to people that are playing a completely different game and expect them to understand it. Like it's not even the same stuff.
Well, the price volatility down in the microcap world will churn you up.
The bid and ask.
Yeah. I mean,
just whether it's on the bid or the ask makes a big difference.
Yeah. So you really have to take it with a grain of salt and understand that, Mr. Market down there he's a little more woolly and wild. And, when he's up at Apple levels, like, okay, he's probably pretty close to right most of the time. And occasionally he'll be off. He'll occasionally do it. And once a decade, he'll forget that, oh shoot, that's still a pretty good business. But down in the lower reaches, if you are worried about a rough ride getting there, then that's probably not the right place for you.
You got to know what you hold.
Quotes every day.
You got to know what you hold. You got to not be worried about where the marks are, because you got a better idea than anybody else who's in it. Mostly because they're really simple businesses.
Yeah,
I used to have guys when I was running Greenback. That was all I was doing. I'd talk to guys and they'd say, do you have any ideas that I can use in the fund? The minimum's 500 million. I was like, no.
Yeah,
500 million is like 5 times bigger than my biggest idea.
So how were your results back then? Like, were you happy with the outcome of what you were doing?
I started it, in late 2008, that strategy, and I ran it through until sort of mid 2010, and the whole portfolio, the whole opportunity set massively popped off. So it was less than what I was doing and more where it was.
Yeah, well, fishing in the right pond is a pretty good thing to do.
Yeah, if you can get
I gotta
that right.
say something real quick because it's just like in my head. If somebody was listening to what I was saying about Ballantyne, if you look now, you better have a view on what you think about owning lumber companies, because the amount of that entity that now is a look-through lumber play is going up. So I just want to make sure people understand what they're listening to. When you were asking about like who are the value guys that might be able to really work, over the next couple of years or whatever, or kind of that evolution of the strategy, I'll be really interested to see how these commodity companies perform, because like I was just on the phone today talking to somebody about lumber and he was saying like there's yeah, obviously there's still a lot of shell shock in the industry. Like the guys that are running it, the operators aren't like too keen to go out and buy new mills because they've been through 10 years of just getting the shit kicked out of them.
Oof.
So, is gold
so
the
many
same?
cycles there too.
That's right. So like maybe it would be a wild outcome, but if the next decade, like the guys that really outperform, it probably started last year, right? But are the commodity guys and the guys that know all the operators and the industries that are just like so shell shocked that they're not going to expand production.
Well, that was the first decade of the 2000s, right? That was, you know, my screen's now full of gold and timber, and not that I want to really own any of that stuff, but it's, it is what it is. You got to kind of buy it when it's there. I don't know. It's just the nature of this business, right? That what worked in the past doesn't work in the future, or it doesn't work for a period of time.
Well, the tough thing about buying into these things now is like, especially timber, right? It looks insane. You're like, what are you doing? So, I think if somebody was like, why do you like what these guys are doing? Well, they're funding it. I think the capital structure is reasonable, and the plan is to pay down as much debt as possible. And if you end up with like a paid off forest, you might underperform the market, but you still own a forest or the rights to a forest, right? It's up in Canada, so you're renting it. But still, it's like, I don't know. I don't have any assets that are natural resource plays in my book. It's probably a reasonably decent hedge.
They've been pretty good investments over time. I think the forests, haven't they?
I think you just got to, now I'm talking about stuff I don't know, but I think you just got to really make sure that you can handle the inevitable part of the cycle where you're not making much money, right? So I would be really hesitant to look at those businesses if they had leverage on them.
I would say that the average tree on planet Earth will have closer to its value in 100 years than the average line of code on planet Earth.
Woo!
Yeah, I need to think about that a little bit.
Well, the code always needs to be refreshed, right? Old code is a depreciating asset, but I think I understand what you're saying, and I like what you're saying.
Should we take some questions?
Yeah, let's do that. But does old code
I'm kind of enjoying
this? Yeah,
it's three of us. Forget that.
Just chopping it up like the old days.
Yeah. I don't know if I can even read these comments. Should have been.
Remember when we had a listener?
Sound it out, Toby.
Remember when they had to write like into the email into Toby's inbox? That was fun.
Yeah. Oh yeah.
You guys have a view on? I think one that we've had. There's a discussion at the moment. CFA versus MBA. Do you guys have a view? Jake, you got a CFA?
No, I have an MBA.
What about you, Bill? Have you got a CFA?
I do. I don't know. I guess I would say it depends on what you want to accomplish. I think the MBA is much, much better for networking. I think the CFA destroys your life for 3 years minimum. Mine was 4 years. Thanks, level 2. You got me once. I see you. But yeah, I really value the members of the CFA Society, much in the same way that I value the people that I met through Manual of Ideas. I think it's a good group of people on average. And, I guess that I have some beef with maybe how that society becomes a business and then it's got its own problems. But I think one of my strengths is networking. So I probably needed that less than I needed some of the CFA stuff.
And you can do the CFA while you're working too.
Yeah, and like Rick Salin, he says
good MBA too while you're working.
Yeah,
fair enough. I thought that the MBA was sort of more, get a good school on the resume and meet a whole lot of people there who are going to go and start big businesses, and you use that network somehow.
I think that's right.
Kind of an expensive way to make friends, though.
But maybe you're using it as like a transition from one career to another. It's a good way to transition.
Yeah.
Yeah, MBA definitely. CFA, I think less so.
Hit us with the questions, amigos. I'm looking, but
Rick Salin has said like he wouldn't. I'm pretty sure he said he wouldn't hire anybody that doesn't have a CFA. Maybe he would make an exception for an MBA, but I do think it proves that you can work hard. It's not a test that you can just like pass. You got to put the reps in.
It proves that you can memorize about 6 textbooks in about 6 months and show up on time. And
that's right.
And synthesize it. Yeah.
Yeah. Don't be coming at my designation, dog. I never know how I'm supposed to say, like, they have like this really, they're very anal about how you say you have it. I think I'm supposed to say I'm a CFA charter holder.
But there's also like if
Bill
you can have
Brewster, CFA Esquire.
That's right. Yeah. Watch me get kicked out just for making that joke.
if you there's some rule about if you pass the tests but then don't pay the dues,
Yeah.
how do you describe yourself?
As a delinquent, which I may actually be right now.
Former CFA charter holder or something like that. There's
Yeah.
some special words.
So I am not an attorney anymore. I was like, I'm not paying Illinois. I don't practice. All it does is open me up for liability. Screw that.
Yeah.
You ever miss law?
No.
Yeah, neither do I. I mean, I never really practiced, but
I mean, the level that I was at, I mean, I did eventually get to the top of the pile, but I started at, like, most of my career, I was just doing DD in oubliettes. So you just go into some sweaty, smelly data room and sit there with a whole lot of other lawyers and accountants and investment bankers and like look at data or like update the data room or something like that. They'd probably do that all online now. That would be a much better way of doing it. But some poor bastard's got to scan it all into, hopefully not the junior lawyers.
Mm.
Here we go. This is much harder without being able to throw it up on the screen. But this is for Bill. As a discretionary concentrated investor, when analyzing a business, how do you decide if a signal, catalyst, positive or negative, moves the needle? How do you separate noise from signal?
I don't really know. I'll tell you what. I got on Spaces last night and Skelecap hopped in there and he started talking about cable companies and it just terrified me about everything that I don't know. So I really don't know. I mean, I think that there is a lot to be said. If I think about things that I have done well in my career thus far, Curate I thought was pretty obvious, but I thought people missed it because of like their historical bias. Funny enough, I think that is why I didn't participate to the extent that I could have in Itasca, and I didn't listen to Mike, and it's because I had followed stuff for a while. But like Charter, I think I was new to the story and I was sort of able to, I mean, I had followed it, but I think that I was able to maybe look at it from a little fresher lens than people would be. And maybe I was just so dumb I didn't know what I didn't know. Transdymal's liquidity. So I just, I don't know. It's, I have bought situations that are out of favor and they've worked. Whether or not it's repeatable, I guess we'll all sort of find out together. And if I crash big, please somebody pick me up.
At least it's public.
Yeah, well, I mean, dude, I don't
GoFundMe.
I don't pretend to have the answers. Half the time I don't know what the hell I'm doing. I just kind of wait. I try to be really patient. And I'm not. Like I trade in and out of shit that's like little. But I mean, my thing that I said about
Kyle, a little bit.
What?
Just to let the crazy out a little bit.
Yeah, man, I have to. Like, it's the sick part of what I am. And maybe that makes me undisciplined and not qualified. And, if that's so, then I got to cop to it.
There's a question here. What earnings yield is acceptable in the current low interest rate environment? I've been like trying to figure that out. And I don't know what the correct answer is to that.
Earnings. Does this guy even look at the stocks that work?
Yeah, well, that's the answer.
There is no answer to that because it totally depends upon the business and the probability of the future cash flow. That's not really, I don't think that's the right way to really do the world, but
yeah,
I don't know.
I didn't mean to blow up your spot, but that was a pretty good joke.
That was a good joke.
I enjoyed that too. I've been trying to figure out like what's the most you could have paid over the last like 5 or 10 years and still done okay. And there's no limit so far that I can determine. But when you look at the S&P 500 and price to sales, like it's at all-time highs. So all-time highs, like higher than 2000. So it's a very difficult question to answer with it. Like being sensible. And I don't know what happens at the end of this. Like everything looks like it's up and to the right at the moment. And I don't know if it's going to pull back. If it pulls back, then Shiller P at 37 is going to be expensive in retrospect. If it doesn't,
be very obvious in retrospect.
I mean, if we get like Japan got to 100 on the Shiller PE, China got to 100 on the Shiller PE. The US topped out at 44, but there's nothing special about 44. We're at 37 and like going vertical at the moment. So we could be back here in a week and say it's at 38, and then at the end of the year it's at 44, and then the end of next year it's at 75. I don't know.
I do think that there's merit to the argument that
money printer go over.
What?
Oh, sorry.
Yeah. I was actually going to say, like, I think there's merit to the argument that you should probably consider what your holdings are doing as a, compared to an ounce of gold and, God forbid, compared to Bitcoin. And like, I mean, the money debasement theory, it's kind of hard to argue with.
Argue against.
Yeah. That's what I'm saying. Like, I mean, it's got some real merit to it.
It's time, amigos. This is a fun one.
Yeah. Have a good one, folks.
Cheers, everybody.
We'll be back next week.